So how do you tell the difference between a healthy AI investment cycle and an overheat story? What are the risk indicators that you monitor?
69 of the world's biggest 100 cities by population within 4 hours flight of Hong Kong. They get a strong sense for where the economic growth of the future might be coming from.
We're seeing increased volatility and weakened confidence in some of the fiat currencies. And I think it's compelling investors and businesses to look for alternatives.
There are countries out there who are taking a view on gold for several different reasons, but an increased wariness of the dollar and overexposure to the dollar does seem to be a big part of their thinking.
Hi, I'm Dominic Bowen, and I'm the host of the International Risk Podcast, where we discuss the topics that matter. And today we're going to discuss gold, which is back at the center of asset allocation debates because of a range of different international risks. Now, gold broke $4,000 an ounce in October and remains near record levels. The drivers are visible. There's heavy central bank buying, there's a resurgence of ETF inflows, and there's strong participation from several nation states, all against a backdrop of sanctions risks and roughly $300 billion of frozen Russian assets. Today, we'll test whether this is some sort of a froth or whether this is a durable change in reserve management and portfolio construction. And with us to discuss this today is Russ Mould. He's the investment director at AJ Bell. Russ, welcome to the International Risk Podcast.
Thank you very much, Dominic. It's a pleasure to be here to try and help.
And whereabouts are you based today, Russ?
I'm sitting here in Brighton on the south coast of England on a bit of a grey autumnal day, but if I fancied, I could probably walk to the sea in about 20 minutes from here, so get a bit of fresh air later on if I needed it.
I would take the sea any day of the week, so that sounds like a lovely spot to be, Russ.
It is, it's beautiful.
Now, gold has been a symbol of wealth and it's been a symbol of power for millennia, and in 2025 it seems to be no different. But we're competing today. We're competing with digital currencies and artificial intelligence. It's really dominating the headlines. Why do you think gold still holds such a powerful place in global finance today?
I think for a lot of people it is still seen as it's been money since, as you said, since time immemorial. So there is always that element to it, and I think that's the first thing to remember. The second is that there is that memory of it being a brilliant investment in the 1970s when everything else basically went wrong, and you could argue there are some uncanny echoes between where we are now and where we were then, geopolitically, financially, economically. So I think they're probably the two biggest reasons why. Although there will be some people who will still to this day say, they'll adhere to the barbarous relic, that it's just not relevant in a modern society. And I think that's because either they embrace digital versions or they go back to the Buffett argument of it offers no yield, it has limited industrial use. We dig it out the ground and we put it in a safe and leave it there. So there is still very much a large school of thought that says, not interested, there are other things I can do with my money.
And we've seen gold prices hit record highs again this year. We've seen these heightened US trade frictions, the announcements of 100% tariffs again on Chinese goods back and forth with the Trump administration. We've seen restrictions on Chinese rare earth exports. We've seen, significant market uncertainty, and partly this has driven investors towards gold. What do you see the main forces driving this? Is it geopolitical tension? Is it inflation risk? Or is it just pure investment sentiment?
There are lots of blogs out there arguing that the US weaponized the dollar when it began to seize Russian assets and ban Russia from SWIFT and international payment mechanisms. And I think that did persuade some monetary authorities to run for cover and seek alternatives to the US dollar. Equally, countries like China had been looking to diversify their dollar exposure anyway because there was sat an awful lot of US treasuries and they could see a wave of treasuries coming their way as American debt galloped higher. And I think that's been another key factor. And actually, you've been able to draw a chart, and I've done it myself, whereby you look at the US annual interest bill and basically draw the gold price against it, and the two pretty much move in lockstep, though gold's now accelerated a little bit higher. So I think geopolitics have had a huge part in that. And then that debt issue, a lot of investors, whether they held treasuries or fixed income instruments or equities, were looking at how are they going to solve this? Because if it can't go on forever, there has to be an end game at some stage. And I think in their darkest hours, a lot of investors, wealth managers that we talk to still fear that the way, if you look at the Reinhardt and Rogoff theory of how do you get out of this sort of debt position, it's either default, no, inflation, well, maybe, grow out of it, best possible solution, but very difficult to do, or you start a war. And so people are kind of leaning towards they'll probably have to inflate their way out of it or do something extremely unusual to get out of it, which could mean more printing, more monetary debasement. So there is an element of the debasement trade in there for the real hardcore gold believers, I think.
Investors often call it that safe haven, and I wonder how accurate that term really is. I mean, how does gold perform when compared to other assets like equity, bond, or real estate in times of uncertainty? And we certainly are in this persistent period of uncertainty.
I mean, in the 70s, it's when gold shone, if you'll pardon the expression, because in real terms, it outperformed everything. When you had two massive inflationary spikes, Nixon smashed up the Bretton Woods standard and took America off the gold standard. And that was when gold really did come into its own and perhaps, gather some of that luster that it still has in the minds of investors to this day. Equally, I guess in a worst case scenario, I was always taught as a very junior fund manager when I started in 1991 and then as an analyst at investment bank later, that during a crisis, all correlations go to one, in that people will just sell anything that they can lay their hands on. And you have seen that even in this gold bull run, 2020, 2021, when everything felt like it was going wrong, there was a big sell-off in gold because the people, there was some profits to be had and people could trade relatively easily, dare one say. So I think that is still a danger, is that, if there were to be a major shakedown of some kind, there's a lot of profits to be had being sat on by a lot of people in gold right now. They may look to liquidate. So that's your danger. But equally, the 70s, it shone, and it has seen us through the last, you could argue, 20 odd years of two big bubbles bursting, geopolitical and the rest. It's seen investors through that really pretty nicely. Thank you very much.
And I wonder if that's part of the reason that central banks, especially in emerging markets like China, Turkey, India, they've been buying more and more gold in recent years. Russ, what's the strategy behind that, and how is it reshaping global finance as emerging markets are buying more gold?
Again, I think that will be, do we want to own? I mean, we know that the dollar is the world's reserve asset, and that's whether you like it or not. And it's a system that's generally speaking worked, really pretty well for the last 70, 80 odd years. But when you have an administration now that can be seen as somewhat capricious in the way that it conducts itself, whether it's, by social media post or by some fairly brute force negotiations, and equally fans of that will say, well, they're getting results, so what? But I think in those respects, it's not necessarily the best way of attracting capital, you could argue. And when America is piling up debt and is going to be selling an awful lot of treasuries one way, shape or form, I think there will be people looking at, well, supply goes up, price goes down, I need to diversify. So I think there are countries out there who are taking a view on gold for several different reasons, but an increased wariness of the dollar and overexposure to the dollar does seem to be a big part of their thinking.
It's interesting you mentioned the reserve currencies. I mean, we're seeing this soaring government debt, and the repayments on US debt is just absolutely at a phenomenal level now. And major economies are trying to push rates lower, even as inflation remains elevated in some markets. And I think this creates a challenging landscape for some businesses. And we're seeing increased volatility and weakened confidence in some of the fiat currencies. And I think it's compelling investors and businesses to look for alternatives. And with equities not paying much more than government bonds right now, when that extra return is so thin, are we seeing the business community move cash reserves into gold at the same way developing economies are?
We've definitely seen it from our customers, individuals or clients who are wealth managers and financial advisors. They've definitely been asking more questions about gold this year and looking more closely, whether that's through ETFs, funds of gold mining and precious metal companies. And in the case of perhaps the more risk tolerant private individuals, some of them have looked at specific individual mining companies, which, let's face it, have done poorly relative to gold overall. I know if you look at the GDX VanEck Vectors Gold Miners ETF and the GDXJ, the Junior Gold Miners Vectors ETF, I think they're up 80 to 100% this year, even after the recent pullback. But if you run their share prices relative to the gold price, the gold has massively outperformed them. And those gold mining baskets have really only just hit record highs now, and they're basically at the levels that gold was in 2011 when gold was at $1,800 an ounce. So you could argue in some ways the miners have got the potential to be substantially more profitable now than they were then, even allowing for inflation and other challenges that they themselves occasionally have to face. So I think that is definitely catching investors' eye, looking at perhaps, all right, have I missed gold to a degree? Well, possibly not, if you look at what's happening with some of the debt, the risk there is of inflation, and governments looking to try and get their way out of this debt mess in that way. But also with gold miners having lagged gold so badly, there may be still some things to look at there, even if, having done the numbers last night, because I think in spreadsheets, having been a trained analyst for a very long time, you're still looking at the major gold miners trading at 3 to 3.5 times book value, which Doesn't sound like bargain basement territory, but equally, given if gold's at $4,000 and your all-in sustained cost of production is $1,800, your profits and your book value are potentially going to grow quite quickly, if all of the things being equal.
And this interplay between government debt, inflation, interest rate policy, and we've seen, it's almost a sitcom watching the interplay between the U.S. Federal Reserve and the Trump administration. But it does fuel uncertainty, and it does shape capital allocation, and it amplifies both the risks and opportunities, like you just said in your Excel sheets. And I think we see this across the business landscape. So, what are the key indicators that you think chief financial officers should be monitoring right now? So when CFOs are considering their company's cash reserves, their investments, what are some of the indicators you think they should be looking at?
I think they'll continue to look at inflation very clearly, and they'll be looking at some of the lead indicators from that. What's coming through in producer price inflation, I think, will be a key factor there. But they will be looking at central banks and how they vote. You do get that sense that the Federal Reserve has got two mandates, which are inflation and employment. Most central banks have got one, which is inflation. You do get the sense that central banks feel more willing to take a risk with inflation to keep the growth show on the road, because I think given Western indebtedness, they just can't afford disinflation, or certainly a Japanese-style deflationary spiral. That would be crushing for Western growth. So you need and equity valuations, and so you need that growth in some way, shape, or form. So you can see why they would be inclined to take that chance. I think that's something that will keep chief investment officers, private individuals, financial advisors on their toes, and I think they'll be looking at that. So if you're going through the bull cases for gold, inflation is, you could argue, one of them. Government debt is clearly another one, and how central banks are trying to manage those at the same time. So they'll be some of your key indicators. If you want to take the positive view, we do in theory have something that's akin to a peace deal in the Middle East. If we were to get something akin to a peace deal in Eastern Europe, then the geopolitical element, you could argue, may have lessened a little bit. So that might make people a little bit more relaxed. So they will be watching some of the big political headlines as well. But I think inflation, government debt, and how central banks are perhaps corralled into helping with that debt by using, frankly, financial repression. If you listen to Russell Napier and some of those fantastic writers, that is a theme that they've been running with for a very long time. And that probably isn't great for fixed income investors. And it means you're looking for another haven. Therefore, gold might be the alternative, particularly if yields are being suppressed and inflation, they're taking a little bit of a chance with it, maybe.
Russ, you talk about yields, and the 10 largest companies in the S&P 500 currently account for about 40% of the index by weight, which is just huge. And I think this underscores that concentration of a handful of tech and AI-driven stocks like NVIDIA, Microsoft, Amazon, Meta, Alphabet, Broadcom, Tesla. And at the same time, if we look more broadly, it's just over half the S&P 500 stocks are above their 200-day moving average. If we look back historically, there's similarities between previous periods of heightened investor expectations, potential bubble risks. I almost feel like the B word is a bad word to be saying these days. But we saw similarities in the early 2000s during the tech boom. Does this concentration and breadth mix look like an AI-fueled bubble to you? Is this something that worries you or concerns you and your clients?
I'm paid to worry, Dominic. So in that respect, I'm always thinking of that. But as somebody who started as a fund manager in 1991 in an equity bear market, that's probably slightly coloured my perception, if the truth be told. So I've always been, protect the downside first, worry about the upside second. But that's how Buffett says you should do it anyway. So I like to think I'm in good company. But you're always wary of using the B word, because the more you talk about it, the less likely it is to blow up. But having been an equity analyst in an investment bank covering tech stocks in the late 1990s, I'm coming out in slightly cold sweats now, because I remember that there are some echoes with where we are now, between now and then. And the team I was on, led by a smashing chap called Gavin White, we went bearish on tech stocks in July 1999, saying this is all bonkers. You've got really high concentration risk, valuations are really stretched, there's a capex bubble brewing here that just cuts into a capex bust really quickly. And we knew we were sticking our necks out, but we didn't really expect the NASDAQ to then double in the next 6 months and make us look spectacularly foolish. All right, we then looked smart for the next 2.5 years, but clinging on through those 9 months was really pretty difficult. And that's the danger with calling bubbles. But I think there are some uncanny echoes now in terms of valuation, concentration risk, companies being rewarded for spending money. You're almost getting, looking at some of the OpenAI agreements recently, which are fascinating, but funding for them is unclear. We remember joking back in the late 98, 99, 2000 about how companies were trading on price to press release. Well, you're seeing something a little bit akin to that now. So yeah, I am nervous, definitely. But if I could tell you when it would end, believe me, I would do, but I can't. All you can do as an investor is calibrate risk according to your own personal risk parameters, and that's all you can do. But yeah, fighting momentum is a hard thing to do. It takes a lot of courage, and you must not have fear of missing out. And I personally, all right, I'm not allowed to run my own money because I'm doing things like this. So I don't want your listeners to think I'm being a smart aleck by buying something and then talking about it on here. But I have no fear of missing out. And my guy is given a very clear mandate, which is A, not lose it, and B, beat inflation. And the rest of it will generally take care of itself. So I have no fear of missing out. But I think there are some uncanny echoes that do make me uncomfortable. And not just my experience. You can see it in the 70s with the Nifty 50, the late 60s with the go-go tech stocks in the US. These episodes are great fun while they run, but they get quite tricky as and when they end.
Yeah, no, it's a really valid point. I thought it was quite interesting some of the things you said just then. So how do you tell the difference? As you said, you're paid to worry. I'm a risk advisor. I'm a strategic advisor. People must say you worry a lot, but I actually spend more time looking at the opportunity and encourage my clients to look at the opportunity and pursue the opportunity, but to do it within a framework. That means you talked about not losing it and beating inflation. I think from a similar framework we might use from a risk management point of view. So I'm wondering about the sort of the risk indicators, and that's really what drives a lot of my work and the advice I give to clients about what are the key risk indicators to your business, whether you're opening up a mine in Pakistan, whether you're looking at deploying resources to Ukraine. So how do you tell the difference between a healthy AI investment cycle and an overheat story? What are the risk indicators that you monitor?
I mean, I think I'll be looking at how these projects are funded, which in the case of OpenAI remains still uncertain. I'm not knocking Sam Altman. I think AI will be the most amazing contributor to the global economy, just as the internet was. Everybody was getting excited about the internet and 3G mobile telephony in the late 1990s, and they delivered everything that everybody thought they would and more by a multiple. And I would think that AI is perfectly capable of doing the same. So I don't want people to think that I'm a Luddite or that I'm bearish on AI. I just look at equity valuations relative to cash flow and the balance between potential upside and potential downside, and that's right. So valuation is my ultimate leading light. Now, OpenAI is a private company, but they're talking their story, and it's pretty clear that they're in burning cash at a pretty rapid rate right now. So putting an equity valuation on that is very, very hard, and it's a substantial act of faith. And I think there are just safer things that you can do with your money looking at valuations. And I think if there is an accident coming, valuation is still going to be your guide. And you look for companies that have got strong balance sheets, management that have seen a cycle or two, scalable business models, and a sensible valuation. And they will probably help provide you with some protection. It might not be perfect, but again, it will get you, as we managed it just as that technology team 25, 30 years ago, we did manage to get from A to B and come through the trouble and came out the other side all the stronger. And as an investor, that's what you're looking to achieve as a CIO, an IFA. And I think if you can help your clients sleep soundly in their beds knowing they're going to get through any rough patch that comes through, you've done your job, and valuation is your key starting point.
Russ, you talked about a few really interesting things just then, and from a portfolio point of view. So, where does gold fit today? You referred to Buffett earlier on, and of course now we've got things like cryptocurrency that only add to the complexity. Is gold a hedge? Is it a speculative bet, or do you see gold as a genuine store of value in 2025?
Again, I think investors have got their own different perceptions, but mine is that it still acts as a store of value. And again, I don't influence my advisor because there's no point having a dog and barking yourself. But I think possibly slightly inspired by Dylan Grice, wherever he's now, Edelweiss Capital or something, and one or two other writers out there. He kind of runs a portfolio of equity income, fixed income in theory, but there's not lots of it in there. And there's kind of infrastructure, there's kind of proxies in there like infrastructure, a bit of cash for optionality. Some trend following funds, just as crash insurance policy, and then plenty of precious metals actually. So it's kind of a 4-5 pot portfolio that's rebalanced, and it's doing its job, said he, touching wood so far. I don't check I only check the statement once a year to make sure he's not run off with it and he's stuck to the mandate, but so far it's doing its job, and gold is being a key part of that. So for me, from my investment perspective, it's doing what I want it, what I would like it to do for my personal strategy, target returns, time horizon, and appetite for risk. Other people will have their own particular perspectives on that, and some may view gold miners as a bit of the sex, drugs, rock and roll of their portfolio, where there is leverage into the upside if things go really well. So it's a matter of personal perspective, but for me, it's fitting the bill as a store of value at a time when Western government debt is a major problem, and they're going to have to be some very creative ways to get out of it, I think is fair to say.
And every gold boom seems to end with some sort of a correction, whether it's the 70s and 80s or the 2011s. How should investors think about timing? And what are the biggest risks right now? when we look at the macro cycles.
I mean, if you look, I mean, the gold price chart did go pretty vertical this year, which in itself makes you slightly uncomfortable. So you would expect there to be a pullback. And again, as somebody who thinks in spreadsheets, preparing for this last night, I won't through all the numbers, but I sat and looked at the three big bull runs in gold that we've had since 71. In 71 to 80, there were three pullbacks of more than 20%, so three bear markets. 2003 to 10, there were two pullbacks of more than 20%, and we've had one in this bull run since 2015. So they are out there, and you do have to be patient and careful. And bull markets, like bear markets, will inflict pain. You know, bull will try and throw you off if you sit on it, and that's what bull markets will do. They will test your faith. So I think there will be lumps and bumps, but equally, given how well gold did in the last 2 or 3 months, a pullback you would view as being perfectly natural and probably relatively healthy, all things being equal. So I wouldn't be too stressed about that. But if you're looking at what could make people move on from gold, because in the end, everything has its time. I've come across a piece from Jefferies, and one or two others have done similar things, and they've looked at to try and how do you value? We've talked about valuation as being a key issue. How do you value gold when it generates no cash? That's why Buffett just puts it in the filing cabinet. So Jefferies have looked and said, okay, well, if we don't worry about gold's cash flows, let's worry about how affordable it is. How easy is it for people to buy it? So that's kind of flipping it round slightly. And they look at the gold price as a percentage of US household income. And they were arguing that gold topped out at 9% of US household income, according to Jefferies. This time it's trading at between 6, 7 right now. So applying that methodology, you can argue on a gold's affordability basis, gold is still affordable for the wider investor and therefore has still got potential to go up. What would make people turn away from it? Well, what's got them interested in it? Geopolitical risks or peace solutions would be helpful. Inflation back in its tin would be helpful. Some solution to government that doesn't involve mass monetization and so on would also be helpful. So those are the things that you're looking for people to lose interest in gold, because that's what stoked their interest in the first place.
You mentioned earlier on about Russia, and I wonder, with the freezing of Russian assets totaling about 300 billion euro by some estimates, has this materially changed how reserve managers think about custody risk and the risk of losing assets, especially with increasing sanctions around the world?
I think it depends upon which jurisdiction you hail from, but from those who feel that they aren't necessarily on best terms with the United States, then I think that's probably correct. It's not a question I've had from our customers or clients over here by any means, but I think that they've looked at it more as I've had a fantastic run in my US equities. I've now got very high exposure because I'm exposed to 7 companies that are at 40% of the index, and that index is 60%, 70% of global equities. So I'm hugely exposed to 7 companies, one currency, dare one say it, one president in some ways, given he's on the news. And every time you open up a newspaper or switch on a radio or a podcast, his name's being mentioned. So we have to be cognizant of that. You didn't get that with President Biden. So I think from a wealth manager or a CIO perspective, it's more dollar and concentration risk. From a sovereign exposure, I think they've looked at that and genuinely felt concerned and feel, well, if they can do it to them, then frankly they can do it to anybody.
And I think that's prompted some of the discussion with BRICS countries, and central banks, notably India, China, Russia, have significantly increased their gold reserves throughout 2025. And this is obviously part of that diversification away from US dollar reserves and building some level of currency independence. As other countries continue to talk about diversifying away from the US dollar, do you think gold will regain its political and strategic importance, not just as an investment, but part of as a new global monetary balance?
That's a really good question. Whether we would go as far as to say that the dollar will lose its status as the global currency, as the global reserve asset, I think that's a big ask, just because at the moment you just haven't got the liquidity or the fungibility in the alternatives. I'm sure there are some people out there who aren't, again, entirely trustful of dollar assets for whatever reason. Either it's their political preferences or their exposures, and they're just concerned about how overexposed they may be. It's a question that's not going to go away. And I think from a geopolitical point of view, I'm not Zbigniew Brzezinski or any great strategic thinker, but I would be wary as an American policymaker not to concoct a situation whereby Brazil, Russia, India, China get closer together. I would be, particularly India and China, that's something I would be very keen to avoid from a geopolitical point of view. And I think you've now got plane routes opening between India and China for the first time in several years, and I think there are plans for more of those. So that sort of thing does suggest that from a foreign policy point of view, you need to proceed with some degree of caution. I'm sure that's, again, something that CIOs will perhaps be thinking about in the very darkest moments. What does that mean? And I think one thing it would mean is, you do need to seriously think about your emerging market allocation, because going to an Albury Capital Management emerging market seminar in London earlier this summer when Louis Gave was there, his stat that was it 69 of the world's biggest 100 cities by population within 4 hours flight of Hong Kong. You get a strong sense for where the economic growth of the future might be coming from, and that's something that as any company chief executive, board, CIO, you really can't not think about that. That's a long-term issue that we all need to be very, very aware of and address and probably try to embrace.
It's a very interesting statistic. And when we look towards the future and we try and project where things are going, what do you think gold's role will be over the next decade? Do you think it's going to remain this timeless refuge, or as cryptocurrencies and stable coins become more and more dominant, do you think it's going to be less financialized and become more volatile?
Yeah, I mean, having been born in 1969, there have been 2 big bear markets and 3 big bull markets in gold. So at some stage, you would expect the music to change and the mood music to change because things don't last forever. And again, looking at that gold's affordability relative to your household disposable income, there might be a level at which you start to feel that's a little bit worrying. And also gold relative to other commodities. That's one way in which you can do it. And again, doing the spreadsheet last night, gold's currently 60 times the average oil, the price of oil when the long-term average is 18. It's currently 80 times the price of silver when the long-term average is 60. So gold relative to other commodities looks a little bit expensive, you can argue, but the more Western governments play with fire with inflation, the more they continue to pile up debt, the more inclined people who were worried about those scenarios will be looking for a haven in gold. You could argue looking at that scenario would still have a major place to play. And I think until gold supporters feel that those situations are changing, I think they'll probably stay with a pretty loyal allocation.
And when you look around the world, Russ, what are the international risks that concern you the most?
I think the one thing that, I look at things with a very narrow perspective of financial market prices, particularly equities, but bonds, commodities, currencies. The one thing that I think is not really expected by pretty much anybody right now is a major economic slowdown or recession. And that would then have a massive knock-on effect upon corporate profits, corporate cash flows, and make in some cases stretch valuations look really quite uncomfortable. And that's what happened in 2000. Was that in the end, yes, the internet did everything that everybody thought it would do, and we've all been very grateful for that, but it just didn't happen as quickly as people thought at the time. And that fixed asset boom became a fixed asset bust, and it switched around really, really quickly. So that's the one thing that I would worry about, and therefore I spend a lot of my time looking at some of my preferred indicators. A couple of those, I look at the Dow Jones Transports all the time and the Philadelphia Semiconductor Index all the time. And if they start to roll over, I start to get a little bit cold and clammy. The transports have rolled over. The SOX Index, not yet, partly because it's got Nvidia in it. So that's possibly now lost a little bit of its value, maybe, but I never like to say things are different this time. So those, again, letting Mr. Market do the heavy lifting for me because it's a lot smarter than I am. Those are certainly 2 of the things I look for. Dr. Copper is another one. The Copper's at the moment doing quite well. So it's not an entirely straightforward picture, but anything that smells really strongly of slowdown would be very troublesome.
You mentioned those 2 indicators that you monitor. Why do you think that they're particularly important?
Yeah, and the Dow Jones Transport, it's Robert Ray's Dow theory. I mean, he wrote about it in 1932, and it's worked. So something can stand the test of 90 years is pretty good in my book. And the argument is, if the transports are doing well, then the industrials have got to be doing well. So if the Dow Jones Transports performs, the Dow Jones Industrials performs. Now I know the mix has changed and all the rest of it, but in the end, it still works. The argument being, if the economy is strong, goods are sold, shelves are emptied, goods have to be reshipped to replenish the shelves. So trucking, airlines, ships, rail, they're doing well. The obverse holds. If things aren't selling, the shelves stay full, the goods don't have to be manufactured and reshipped, so the transports will do badly. And at the moment, the transports rolled over last November. And that's not necessarily a great sign. The SOX, the Philadelphia Semiconductor Index, silicon chips, it's a $600 billion a year global industry, and silicon chips are in everything. From this laptop I'm staring at right now, to my mobile phone, to my car, to my fridge, to my smart meter, they are everywhere. So again, the SOX is a great guide for global economic activity because of the ubiquity of silicon chips, and also silicon chip stocks are momentum jockey stocks. They thrive off upgrades, they recoil from downgrades. So again, they'll give you a good feel for appetite for risk across the wider market. If there's one thing I'm looking for this time that I probably didn't look for before, there's all these issues about private credit, private equity. So if, I'm looking at, is this where there's Jamie Dimon's comment about more than one cockroach the other week. So I'm kind of looking at that and looking at the share price of things like RS Management, which is a big private credit provider, or the S&P Global Listed Private Equity Index, and they have rolled over. So again, if you read Richard Buxteber's book, A Demon of Our Own Design, and it's somewhere right there over my shoulder, he says that any bull market will feed off and then founder upon 3 things: complexity, opacity, and leverage. And I would suggest that private credit ticks all three boxes pretty comprehensively. So that's probably why I'm, again, with my worry wart hat on, probably doing a little bit of digging around there as best I can. But by definition, private credit is private, so therefore there's an element of opacity there before we even start.
No, I think the private credit market is certainly a very interesting one and an increasingly important part of the market. But as you said, very opaque by its very name, private, which makes it hard to fully get your head around. Well, Ross, thank you very much for coming on the International Risk Podcast today. Really interesting conversation and very insightful.
It's been great fun.
Well, that was a great conversation with Russ Mould. His long experience in capital markets began in 1991, and today he is AJ Bell's investment director. I really appreciated hearing his thoughts on gold and how it shifts according to geopolitical trends and, of course, the international risk landscape. Please go to the International Risk Podcast website and subscribe to our mailing list to ensure that you get our bi-weekly newsletter in your inbox every week. This episode was produced and coordinated by Melanie Mamoon. I'm Dominic Bowen, your host. Thanks very much for listening. We'll speak again in the next couple of days.